Hey everyone, Ian King here with your weekly Winning Investor Daily YouTube video. We're going to talk about the Fed meeting on Wednesday. What does it mean for markets? What to expect going forward? And I also want to talk about the Fed's credibility, which I think is the most important thing here. But before we do that, if you like our content, please go ahead and smash that like button. Subscribe to our channel if you haven't already, and feel free to leave comments below. We love hearing from you guys and love answering your questions in future webinars. So let's talk about what happened on Wednesday. We had the FOMC meeting. The Fed came out. They raised rates by 75 basis points. They indicated that they are going to continue with a strong hike of interest rates, and the markets did not like that. We had a very volatile session on Wednesday. We sold off again on Thursday. And what does this mean going forward? Well, if you think about the Federal Reserve and why it was first created in 1913, the charter was all about keeping prices stable. Now, in the 1970s and 1978, to be specific, the Congress instituted the Fed's dual mandate, which essentially meant that they have to keep prices stable, and they also have to create an economy that maximizes unemployment. So that was the dual mandate. Then things changed again in 2008 during the financial crisis. Congress gave the Fed more power, specifically to buy assets on the open market. So since 2008, the Fed has been engaging in one type of operation or another that buys longer dated assets. These are government bonds or mortgage bonds, or even more recently corporate bonds. And what that does is it keeps the interest rate low on mortgages, on government bonds, and lower interest rates on these instruments means that capital will flow to other assets such as stocks and cryptocurrencies. And we've seen a lot of that in the last couple of years, and now that started to reverse. And I think what happened is the Fed really got behind the curve of inflation. A year ago, the Fed was telling us that inflation was transitory, and they also instituted this policy that basically kept rates at 0% until inflation went above 2%. Once inflation got above 2%, it went to 4%. And in this summer, we saw 9% on the consumer price index. And so now the Fed is trying to raise rates as aggressively as possible to combat the fastest inflation that we've seen since the early 1980s. Now, there's some differences between now and the 80s. In the 80s, you had inflation that was really embedded in the economy. It had been going on for about a decade, and the Fed in the 1970s under Artie Burns tried to fight inflation, but once it looked like they had gotten inflation beat in the 70s, they decided to, sit still and start decreasing interest rates. It really wasn't until Paul Volcker came along in the late 70s that he said, I don't care. I'm going to do whatever it takes. I'm going to raise Fed funds rates above the rate of inflation. And that basically broke the economy and also broke inflation, but it paved the way for tremendous growth over the next couple decades in the 80s and 90s in the US economy. And I think we're getting into a similar situation right now where Jerome Powell is having his Paul Volcker moment. He is trying to establish credibility. He's trying to make people and investors believe that he is going to do basically whatever it takes to beat inflation. And you got a hint of this yesterday because I watched the Q&A on Wednesday, and there was this question that one of the reporters asked at the end. Basically, they said, do you still think you can get inflation down to 2%? And as Powell was leaving the room, he looked at me and said, you just wait and see. And to me, this guy sounds serious. So let's look at some of the dot plots, some of the things that have changed from this FOMC meeting to the other to show you that the Fed is taking this seriously and they are going to maintain their credibility, which in my mind, the Fed's credibility is the most important thing here, because if the Fed loses credibility, then it has no levers to pull in order to influence the economy and change the direction of economic growth. So right now, I'm going to share my screen right now, and we're going to first look at the Fed's dot plot. And this is what the FOMC releases for every meeting. And what this shows is there's 19 voting members, and they basically put a dot in where they think interest rates will be at the end of a specific year. Okay, so here's 2022. And so at the September meeting, most of the participants believe interest rates would be up here around 4.5%. And that is similar to what it looked like in the June meeting. The most interesting change is that in the 2023 year end, most participants in the last meeting believed that we would have interest rates around here at 3.5%. That has gone up significantly to between 4.5 and 5%. And you can see this in the 2-year note. The 2-year note is a government bond that expires in 2 years. So if you're an investor, you can buy it and you'll get paid a 4.12% yield for the next 2 years. And what's really interesting is that 2 years are now the highest yield that they've been since the financial crisis. So if I go on all of this chart, the last time 2 years were this high was 2007. So we're at about 4.15%. You got to go all the way back here, when the 2 year was at 4%. And this indicates to me that the market is believing that the Fed is going to hold interest rates higher than most people thought recently. Because if you look at the chart of the 2-year yield going back let's go back 1 year. Let's go back 5 years. You can see that even in early this year, so in Jan 2022, the 2-year yield was 73 basis points. That was less than 1%. I mean, this is an incredible move in interest rates, in short-term interest rates. This is not something that you see frequently, that the 2-year interest rate has gone up 4 whole percentage points in 9 months. And what this tells me is that basically that there is significant competition for stocks right now. So if you're an investment allocator and you can choose between fixed income or stocks, when 2-year yields were 50 basis points, it would have run you out of town if you bought any of them. You had to be in dividend paying stocks or some type of corporate bond. Now the U.S. government's going to give you over 4% on a 2-year note. That's significant competition to the stock market. So with yields this high, it's also going to slow credit growth, which means that the economy is going to slow down, and it's going to suck a lot of capital out of the stock market. But the good news here, again, is that this comes down to the Fed's credibility. They lost their credibility by staying behind the curve on inflation, and now they're fighting to get it back. Yesterday's FOMC meeting was a big step into getting their credibility back. So I think that the 75 basis points, even though this medicine is going to feel really rough at first, and the economy is probably going to slow down a lot faster than people anticipated, but it's going to give the Fed's credibility back in the long run for the economy and for stock prices. This will turn out to be a better scenario than if they just had kind of, sat by and let inflation get embedded in the economy at 9%. So that is where I'm at on what the Fed did. Would love to hear some feedback, what you think about the Fed's move, how you're positioning yourself. If you're considering buying any of these 2-year yields at 4.12%, please leave comments below our YouTube video. Thanks again for tuning in, and I'll talk to you next week. Take care.